Today, new FTX management says the now bankrupt crypto exchange transferred billions of dollars to its disgraced founder, Sam Bankman-Fried. A new report from the FBI finds online crypto scams nearly tripled in 2022. And Andrew Thurman of Nansen breaks down the de-pegging of USDC over the weekend. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Digital currencies are back in the green this morning. By noon Eastern, Bitcoin traded right below the $25,000 mark. Ether was worth about $1,600 and Polygon jumped to $1.14. The rise in Bitcoin and other cryptocurrencies comes amid growing uncertainty around the global banking system, with Credit Suisse and First Republic Bank as the latest institutions receiving new liquidity to shore up their balance sheets. Okay, let's talk about the top stories. First, FTX transferred about $2.2 billion to founder Sam Bankman-Fried through related entities. That's according to the bankrupt crypto exchange's new management. In a statement yesterday, FTX said overall more than $3.2 billion was transferred through payments and loans to company founders and key employees. According to the firm, the payments were mainly made from FTX's sister hedge fund, Alameda. It made these disclosures by filing schedules and statements of financial affairs with the bankruptcy court. Not included in the transfers was more than $240 million spent to purchase luxury property in the Bahamas, political and charitable donations made directly by the firm's debtors, and substantial transfers to non-debtor units in the Bahamas and other jurisdictions, according to FTX. We reached out to SBF's lawyers, but as of noon Eastern, hadn't heard back. Next, SEC Chair Gary Gensler is reportedly doubling down on his stance that proof-of-stake tokens could be securities. According to the block, Gensler told reporters yesterday that proof-of-stake tokens fall under SEC jurisdiction. He made the statement when asked to respond to comments made last week by the CFTC chair, who reiterated his belief that Ether is a commodity. The SEC has long argued that many tokens should be considered a security under the Howey test, since investors buy them with the expectations of returns derived from the efforts of others. Therefore, the SEC says they need to register with the agency. Gensler added that he would suggest each of these token operators seek to come into compliance, and the same with the intermediaries. And just last month, the SEC undertook its first staking-as-a-service enforcement action, settling with Kraken. The crypto exchange announced it will close its U.S. staking operation. And finally, a new report from the FBI says Americans lost more than $10 billion to internet scammers last year, with a large part of that coming from crypto scams. The FBI's 2022 Internet Crime Report found that crypto investment fraud rose 183% in 2022 to more than $2.5 billion. Now, across the board, scammers raked $10.3 billion total last year, up from $6.9 billion. But the total number of complaints fell from 847,000 in 2021 to 800,000 last year. One thing to note, this only includes scams reported to the FBI, so the total number of scams and money lost could be higher. All right, on to our main story. The USDC stablecoin lost its $1 peg after the collapse of SVB before recovering as regulators stepped in to protect depositors. Crypto World's Talia Kaplan spoke with Andrew Thurman, head of content at the blockchain analytics company Nansen, to break down all the on-chain data and what's next for USDC.
After Silicon Valley Bank's collapse, USDC lost its $1 peg. Now it came close to regaining its dollar peg after Circle, which issues the stablecoin, said that the $3.3 billion it held with the now collapsed bank will be fully available when U.S. banks open. You argue that while that news successfully managed to restore most of the USDC peg, the story is not over for the troubled stablecoin. Can you elaborate?
The second and third largest banking collapses ever were indeed Silicon Valley Bank and Signature, and they happened within a 3-day time frame. It's really difficult to overstate not just what this meant for crypto in terms of this panic around USDC, but what it also meant for the broader banking ecosystem. And so I think as a result of these various calamities, crypto markets whipsawed all weekend, drawing down sharply overall, and the depeg led to general panic. It was unclear if these markets that once hedged using stablecoins could trust stablecoins anymore as a safe haven. And that seemed at times during that very dark weekend to be posing an existential risk. However, I'd say that something very, very curious happened. A lot of people expected that bank stocks writ large would collapse, and a lot of people expected that crypto stocks would follow. Um, and what happened instead was that bank stocks did collapse. Many huge names, Charles Schwab was down 20%, but crypto rallied. Many major tokens were up 10% or more. And this goes against popular understanding of how the sector works in reality. I think for years now, true believers have been arguing that crypto is a hedge against the traditional or legacy financial system and a way to opt out from these sort of boom and bust cycles. But in practicality, crypto has often acted as a higher upside and more volatile analog of traditional markets, particularly the tech sector. A lot of people like to call it just a high beta NASDAQ. But on Monday, finally, people treated it as, in many ways, it was meant to be used. When the fractional reserve banking system seemed to face true stress, people fled to native unbacked crypto assets like Bitcoin and Ether. They weren't using USDC as the hedge anymore. USDC suddenly seemed like the thing that's unsafe. They went to native crypto assets. I don't think we've really seen the long-term ramifications and the long-term impact of that. Whether or not that's a one-day phenomena is debatable. We simply don't know yet. But if people no longer see stablecoins as the source of refuge, and they're really beginning to believe in crypto assets as the hedge asset, that has long-term impact on market structure and how these markets are going to evolve.
So Nansen pointed out on Twitter this week that in the past few days, 3 tech and VC-friendly banks were shut down by the banking authorities, noting that this could result in banks tightening lending standards further and investors becoming more risk-averse. Can you take us through some of the other things Nansen expects to happen now?
It's a good question. I think right now we saw a little bit of what a shift away from USDC could look like when there was a regulatory crackdown on the Paxos issued but Binance branded stablecoin BUSD. Paxos was issued a court order to prevent them from printing any more BUSD, and since then has faced a wave of redemptions, billions and billions of dollars in outflows. BUSD was, however, the primary source of liquidity for both the Binance centralized exchange trading platform as well as the Binance Smart Chain decentralized finance ecosystem. They have successfully so far managed to pivot to other stablecoins, primarily including Tether, USDT, as a way to mitigate the sudden liquidity crunch and the real utter destruction of their primary source of trading liquidity. We haven't seen quite the same thing with USDC yet. USDC is structurally important for many centralized exchange platforms, including Coinbase, which services direct USDC to USD transfers, and the DeFi ecosystem. USDC is hugely important there, where it is one of the pairs for many of the most popular trading liquidity pools for decentralized exchanges. It is hugely popular as a form of collateral on lending marketplaces. It is the primary source of liquidity for many cross-chain bridges. It serves a role that's really difficult to imagine somebody else replacing it. And we have yet to see if Tether can step up and fill that role, or despite this panic, USDC will manage to keep its pole position. Right now, it seems like the net outflows have been under 3 billion. There's more than 38 billion USDC still in circulation. It's still very important to these markets, but that could change if investors remain cautious or skittish after these really historic moves.
So Ethereum's next big upgrade is now expected next month, and the Shanghai upgrade will let users withdraw their staked Ether. What do you think will happen then? Do you think once this ETH becomes unlocked, there will be a massive dumping of it on the market?
It's a very good question. And I think you might as well ask me what the numbers are going to be on the lottery ticket next year. So to set the scene a little bit for Shanghai, this is going to be perhaps the most important market event of the year, and it might well fundamentally alter Ethereum's price dynamics. Nansen's going to be watching this very closely. Obviously, this is a huge moment for the world's second largest cryptocurrency. This is a big shift that began with the opening of Ethereum's staking contract a few years back. It continued with the merge, and now with EIP 4895, which is a key part of the Shanghai upgrade that is going to allow for those withdrawals from the staking contract. This transition to proof of stake in some ways will be complete or close to complete, and that has major impacts on how Ethereum will behave as an asset moving forward. So, as you pointed out, currently there's a big debate going on between analysts and researchers about how EIP 4895 will impact price. One theory is that a successful network upgrade will actually get more people to deposit because there are investors who are simply waiting on validation of technical success before depositing their Ether. If that's true, obviously it will reduce the amount of circulating Ether at a time when the Ether supply is already shrinking due to burns. And obviously this would buoy price. Conversely, however, there is this issue of what if more Ether enters into circulation? There's a huge amount of Ether staked, I believe over 17.5 million ETH, which would be a top 5 cryptocurrency in its own right, just the amount of Ether in the staking contract. That will hypothetically be able to be withdrawn and sold, which would create a massive headwind for the asset, potentially right at the dawn of a new bull market. Ultimately, however, I think on a long enough time horizon, I expect that proof of stake is going to entice investors who are looking for real yield. It's going to make Ethereum a much more attractive asset. We just need to see who is withdrawing, what they're withdrawing. Are they withdrawing their full stake or just their earned rewards? What percentage of the withdrawal addresses are restaking? What's the net inflow, outflow, and net flow to the staking address? These are all key metrics you need to be keeping an eye on in order to have a sense for how price will react immediately after Shanghai. But on a long enough time horizon, like I said, I think no matter what, it's a bullish outcome.
Okay, that's all for Crypto World today, but we'll be back again tomorrow, so we'll see you then.